And as investor confidence in U.S. assets weakens, global capital is steadily shifting towards emerging Asian markets. A downgrade in U.S. sovereign credit, soaring treasury yields and fiscal concerns are pushing investors to look for more stable and growth-driven opportunities. And markets like India are stepping up to fill this gap. Foreign investors pumped $2.7 billion into Indian equities in the first half of May alone. This marks a sharp turnaround after investors sold billions worth of equities in the first 3 months of 2025. April was the turning point with net purchases in the green. Analysts attribute this shift to improving domestic fundamentals, cooling inflation, and expectations of further rate cuts by the Monetary Policy Committee. A key driver behind the foreign inflows is SEBI's proposed reforms aimed at reviving global interest in Indian government bonds. The regulator has suggested easing KYC timelines, waiving trading and demat account requirements, and offering flexibility. Experts see this as a strong signal aligning India's bond market with the global norms. On equities, FIIs are replacing their biggest bets on private banks, citing clean balance sheets, digital transformation, and room for valuation re-rating. India's inflow surge comes amid broader shifts in global capital flows as well. Moody's recently downgraded the U.S. sovereign rating, triggering a rise in 30-year treasury yields to the highest since November 2023. Meanwhile, China saw a net capital inflow of $17.3 billion in April, including $10.9 billion in bond investment. With the dollar weakening and the U.S. fiscal deficit ballooning, analysts expect a structural move towards emerging markets like India, China, Korea, and Taiwan.